Ladies and gentlemen, traders, investors all over the planet who tune into our monthly show with TradeStation, we're thrilled to have you back again, especially because I think everyone now is aware of how much has happened since the election. It's been pretty exciting across all markets, and we've got David Russell here with us from TradeStation. We're going to jump into all of it. Now, before I do get to David, he's got charts ready for us. He's got everything prepared. Let me first just remind you all why this stream is possible in the first place. This show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. Equities, equities options, and commodity futures products and services are offered by TradeStation Securities Inc., member NYSE, FINRA, CME, SIPC. So I say all that just to make sure you all get a good lay of the land and why this is possible. And if you're on TradingView, you know that TradeStation is a connected broker, which means you can connect your TradeStation account to your TradingView account and place trades from the chart. And also, David Russell runs the TradeStation account on TradingView. So you are talking to the man who is creating all of this in-depth research for you once a month, unlimited access to him in this show. David, post-election, let's dive right into it.
All right, great stuff. It's good to be back with you. Well, for a while, we've said that this chart, the 10-year Treasury yield, is actually the most important. And, I think it still remains pretty important here. Now, let's say overall, we're in an environment here where I think that there's like a few different trends to think about. There's the uptrend in the S&P 500. But we've talked a few times, even look at a longer view chart here of like a 2-week candles. But the 10-year Treasury yield has been in a downtrend for most of my life, which started in 1975. And basically, this defining downtrend into interest rates has been the most important thing possibly in modern history of finance. It has made all sorts of things possible in terms of investment. And, we've really been in this downtrend, and we broke it coming out of COVID. And now we're seeing signs of that longer term breakout remaining in effect. So we had talked a lot about a level from back here in June of 2008, which was at 4.324. Right a little bit, about 4.25. And I think it's important now that as we look at this, there's signs that maybe that level is going to break out. Now, I kind of had the expectation that, as the inflation came down, we would see these yields move back down into this range. But things have not really worked out that way. And, there's Mark Douglas, great trading kind of guru and thinker, had that idea that, in trading, you need to have this idea of the now opportunity flow, the idea of knowing what's working now, despite what you think, and having the ability to kind of change direction. So I did have this expectation, but then what happened here is we basically went under our December low and kind of a false breakdown. And then if you look here, we have this low from March of 23, and now we have a higher low in September of this year. So, we are above the last peak before COVID in late 2018. And so there's a decent argument here that Treasury yields have truly reversed to the upside. And that could have, and when you consider that it was a 40-year downtrend, this could be something that has continuation. And I think that this needs to be a main sort of thing that we're aware of. So right now, the fact that we have gotten above this level that we had talked about before at 4.324, now gives me a sense that we might actually be in for yields going above 5% on the 10-year. And just to realize what that could mean, it does create an environment that is not as favorable for equities. And so I'm putting those pieces together, and there's a lot of arguments about this when you look at it, politically, fiscally, tariffs good, tariffs bad, whatever these sort of arguments might be. But the fact is, I mean, obviously, this is a politically fraught issue. Just given some of the things, politically that people are wanting to do and things like that. But regardless, I think it's important for us to realize that in many ways, it's like we're in a big, giant, bouncy house. And if the air goes out of it, that means things to everybody, to all assets. And the fact is that in many ways, we have relied, the American economy, the American financial markets have relied on relatively low interest rates. And if we are now in a period of long-term rates moving consistently higher, that can have overall negative effects. And we might be starting to see it now. And I think we have to hold that back as being something of a possibility that is getting there.
Wow. And I have to add to that as well, your comment about this being the most important financial chart of our lifetime, especially that downtrend. And then now this possible breakout is for all the new traders out there. It's so interesting because this is such an important chart who don't understand why it matters so much to risk on assets or risk off assets. Maybe you could just give us a high level educational reminder about how this can impact things like equities or other risk on assets if it continues to climb higher.
Well, I mean, one obvious answer is that valuations alone, if people can get 5%, or 4% or something in money markets or different kinds of fixed income with little risk or no risk, they have no reason to um, take risk in equities. That's one thing. But the other thing is the impact it has on the economy. So first of all, those higher rates translate into lower multiples in terms of PE ratios or price to sales or price to book or anything like that. That's the first argument. But the second thing is the declining interest rates had an effect of pushing up asset prices. And the thing is that if people feel like their houses are going to be worth more, they'll spend more, not just on houses, but on buying things for their houses. They'll feel more house rich. There'll be more desire to invest in things. And as interest rates move higher, that is one of the most important things for potentially discouraging investment. So I think it's important to realize here that this is something that if you think about if you're a bank or something and you have made a loan at 3% and now rates are at 5%, you're underwater on that asset. And there's different ways to manage that risk. It doesn't mean banks are going to go bad, but it does mean that overall they're going to have less incentive to lend to others. That's going to mean that the financial conditions tighten and things like that. So I just think this is important. It's just that our country runs very large deficits, and there have been people warning for a long time that too high deficits can turn into real problems, and we might be getting evidence now that that is starting to happen. I want to emphasize though that I don't want to be overly kind of focused on this in terms of it matters right now. If you look back to the financial crisis, and I'm not saying this is like the financial crisis per se, but the fact is that if you look back to the financial crisis, the first real shock waves of it, or the first indications of it, occurred in early 2007. The real crisis didn't happen until the second half of 2008. So we might see things like this: yields move higher, and then they moderate, and they sit and they wait, and things happen. So this is not, to me, something that right now just means that everything's going to be bearish, but it does mean that we are starting to see more of this sort of risk play out. And the fact is that if it continues higher from here, the kind of narrative, the things that I'm saying now, will become more of a point of discourse in the news, in commentary. Analysts, people will start to say, well, if rates are going to be higher, maybe multiples should be lower. And then companies say, well, maybe it's going to discourage investment plans or things like that. So it's something that has a broad effect. It's like the weather. If it goes from being 80 degrees to 60 degrees, and you just look at people, sitting around in a park, they dress differently, they behave differently. Well, it's the same sort of thing like this with interest rates. So I just think this is something we need to be aware of, because the idea of wider deficits or things like that, I think are, something that really can have a big impact. And the other thing I'll just say is the fact we made this higher low here with a false breakdown, the fact that we've now spent an entire week above this old level. We went above it, we came back down, and we came right back up. This is looking more like we're headed for a potential longer term breakout, especially because we had a clear break of the downtrend. We see this high from 18, that became support. last April. And now if you actually look, there's another level here where this thing came from there's another level from early 11 where basically we held this level here around 3 3/4. That basically was the low in December. We had the false breakdown under that level. So I just think right now this has to remain something of a concern. And the thing though is that um, it has to at this point. I mean, it hasn't really clearly broken out and become a big issue, but it does remain there. And when you look at some of the things that have happened with inflation and some of the expectations going forward, I continue to think that this remains, a concern. And I just don't want us to not look at it because the fact that we just continuing to close above it is maybe giving a little bit more sense that we could be headed closer to 5%.
Well, I just have to say for all the viewers watching, that right there is why we love doing this show so much, is these reminders about why these symbols are important to watch and what they mean at sort of the big picture level. There's a lot of traders out there. I don't think many of them are fully aware of how important this chart is of TNX, the 10-year Treasury, and that overview and background was really helpful, even for me. Been doing this for over a decade. Like that refresher about, yep, that's right, this is a really important chart, is really nice to hear. And I hope a lot of the new traders out there sort of got that as well. They can always click back to rewatch it. Now, what other charts and sort of market movements are you watching, especially since after the election, I'm still trying to wrap my head around like what just happened. Tesla went bonkers. Small caps broke out. There's so much happened in such a short period of time. That also does make me a little cautious. It happened so fast, but yeah, let's see what you have for us.
Well, I'm looking at here, the S&P on the daily, and what's interesting to me is if you actually look at the high above the October high, we pretty much held. At this point, we're trying to hold. This is a daily chart. We're trying to hold essentially the a 50% retracement of this level. So I mean of this move, and that would be a confirmation of more move to the upside. Now, I'll say that most of the indications I see in the S&P 500, there's nothing bearish really on it yet. So I just think that is an important thing to kind of say. And the other thing is that in some ways, if interest rates do kind of grind higher, that would actually favor people going back to, for example, the NASDAQ, the large cap NASDAQ stocks, and away from some of these names we've seen recently, like small caps, or like some of the more speculative tech stocks that have done well, or even things like Tesla, and just going back to the names like the Apples, the Microsofts, and the Metas, and things like that. So I think it's important to realize that the main thing we want to look at really is the S&P here. And this initial thrust, we're holding a 50% retracement, which to me is pretty interesting. Another thing that's interesting is we had kind of gone out on our webinar earlier this week, and we had actually mentioned the level to look for a test that was basically the low of Thursday, the 7th. And that low was 59.47. And today's low, I'm just looking at now, was 59.46. So we tagged the level that we had been identifying earlier this week as being the level that was likely to provide the first support. We hit it I think as we were starting to speak. So from my perspective here, this is still kind of continuing to do what people would want to see for continuation to the upside. That's the first thing here on the overall S&P. The other thing is, if you look on an intraday chart, and I'm not sure if this is as important as it used to be, but there have been times when a high occurs on a Monday morning, like this one. This high occurred in the first 10 minutes on Monday the 11th. That has often been a sign of a top. I've seen that before, and I'm not sure again how much I would put overly too much stock in something like that. But I did want to mention that. To me, the key thing we see here, first of all, I'll say holding that 50% retracement. If we put this now on the weekly of the S&P, if you look at it like this, the 50% retracement of the breakout. But if you even look at last week, for example, if we look at the entire weekly move or the close from the previous week up to there, we're nowhere near a 50% retracement. So if you look at this overall, there's nothing yet that gives any kind of significant sign that we have any kind of significant downside risk. Now, I wanted to now show, for example, one of the things we've looked at is the relative strength indicator, the relative strength index. And we've talked about this idea of RSI getting up, kind of above in the 50, 60 range and just sitting there. kind of this idea of like RSI cooking, as we've said. And I think that the important thing to realize is that that indicator seems to be still very much in effect. RSI going up to these levels, I've noticed this, is that on the daily chart, we've mentioned how RSI can very often function as essentially a directional indicator, not just an overbought, oversold. So if you look at over time, when the RSI kind of goes up to overbought and stays there, that or near overbought, it suggests that we don't get significant pullbacks, and that is also in effect. Now you can see we have these tight consolidation patterns. This has been a common pattern in this market for the last year, when we get these kind of tight sideways movements, and it looks like that might be what we're starting to get right here. So I think this is kind of, if you look at it like this, the market will, very limited pullback, sideways movement, and then extension. It rallies to new highs, goes sideways for like 2 weeks. You think, oh no, it's going to crash, and then extends. So same thing down here. So I would just say this is a way to think about it right now. And I look at the market, and I wanted to kind of cite the whole Mark Douglas thing, because you have to have the now opportunity. And I would say that there's kind of, two possibilities. One is that yields more or less peak here, chop lower, and if that happens, the S&P can extend higher. But the other possibility could be a breakout and continuation, and then that could be the thing that triggers some kind of pullback to the S&P back to these levels. And the fact is, as traders, it's not a good idea to have a strong idea. It's a better idea to really see what the market wants to give you, what kind of signals it wants to give you, and to react to that, and instead of trying to say or make some kind of prediction. So I would just say that that's really the main focus for me, and we're holding the 50% retracement. And the other thing I'll just say is, when you make a call, often days and days later, it will happen. And the thing is, I think mentally, when you make a call based on reason and based on non-emotion, it's often important to remember the validity of that call. So the call that I had made on my webinar on Monday, where they basically had said that the first support level was the low from last Thursday, and then you have all this space up here when you chop around and you maybe don't know what's going on, but then boom, you go down and you hit that level. So I had an alert set on TradingView for that very level, went down, and it hit it right around the time we started talking. So from my perspective here, I do think that this remains overall the trend to watch. And I'll just say that you can have negatives building in the background, like higher interest rates. Those can build for a long time before they actually have an impact. So just because there's potential risk building doesn't mean that those risks are going to turn into some kind of correction. There's that old saying, never short a dull market. And the other thing I'll just say is the VIX has refused to go up. And I think it's important to realize here, if we look at the VIX basically was, it has not gone to single digits since COVID. And now that the election is done, now that we've been through the Fed hiking rates and cutting rates and everything else, in some ways here, we could be in a spot where the VIX doesn't have a lot of reason to go higher for a while. And if the VIX continues to bleed lower, then it could be a spot where the sellers simply are not going to be active for a while. The market can actually have something that it drifts higher, it ignores higher yields, and then at a certain moment, everyone decides it's a problem, and that's when the pullback happens. And that could be weeks from now.
David, that was awesome. And there's a lot to unpack there. And I was keeping some mental notes on a few things I wanted to ask you about and dive a little deeper into. The first thing, just because I find it to be kind of entertaining, is I think I heard your alert go off when that level was hit on the S&P 500. And as I was watching markets, because I have two screens open, when you were going through the TNX part of the chat, of the market's not watching our show, but I thought it was pretty interesting because the S&P 500 just started dipping so quickly. And just the coincidental nature of markets is just always fascinating. Now, in terms of the quotes you brought up are great, from Mark Douglas, and never a short a dull market. And the other aspect too was sort of about the concept that all these bad things could be going on for a long time, and the market doesn't honor them until a certain date. And it had me thinking of that quote about, it's like a Peter Lynch one about, more money's been lost preparing for bear markets and has actually been made in bear markets. And when you were explaining that, that was going
Interesting.
through my head. However, at the same time, we do know bear markets always arrive at some point. And it's just a fascinating thing that, these big shifts are really hard to time. And on that note, with this S&P 500 chart, do you feel like and how about the market in general, it's just gone too fast, too quickly since the election news? Or do you think actually this sort of holding up nicely at this point?
At this point, it looks to me like we're in the smooth stages of the uptrend. There is no rule, there is no referee or police officer who's going to tell the stock market it has to stop going up. It's going too fast. It simply is a matter of supply and demand. And so, from my perspective here, what's interesting is there are some indicators that, if you look right here, I put on the 8-day exponential moving average. We're right down when near that. There's another moving average that I don't know if I have on this chart. I think I can bring it over. I have the 10-day simple. It's my own. No one really uses it, except for myself that I'm aware of. But I've just noticed that the 10-day simple as a directional thing, when it starts to kind of, when you sit at it and it can, then it pulls you lower. Well, we're well above it. It's rising quickly. That is a sign of short-term bullishness. The 8-day exponential, we're basically just, probably a few points away from it here. So these things give no sense. And I think it's important to realize that it's really important to focus on the short-term momentum and direction, because once things move in a certain direction, that can remain longer. It's like, I guess like John Maynard Keynes, another one, he was, had some good things about, trading. And the idea was that the market can be irrational longer than you can be solvent, or, it can basically keep going based on those short-term momentum. So when you're looking for that bear market to happen, you want to actually look for the confirmation of it. So if we look here, look at that pullback we had over the summer. We basically had the 10-day was falling. You basically had the 8-day exponential was falling. The 21-day exponential was falling. The 8-day was under the 21-day. Well, those things all gave you a sense that direction between July 16th and July 30th, which is a long time, had basically changed. And here we have no such evidence, no such indication of anything like that. So I think that's really the main thing for here. And at this point, it's interesting. Jerome Powell came out and gave a speech as we started speaking. It also seems like it was somewhat hawkish. And I think again, now what else is there? There's no other really clear risk that can really be, out there. We've had things like today, like the jobless claims are relatively low. So at this point, we might be at a spot where the thing I said about the 10-year, that might have worked its way out for now. I didn't want to overemphasize it. I just have to emphasize it's there. And for a long time, this has been a concern of people. And the fact that we had this very rapid rise in yields after the Fed cut rates. There's some certain things there. When something doesn't do what it's supposed to do, when rates rise when they should be falling, you should pay attention to that. But also, I think what's important to just realize is that it hasn't yet clearly translated into anything. If anything, it's translating into a migration away from the Russell back toward the Qs. So I love this sort of, I think it's RUT divided by NDX. I have, and wait a second, RUT divided by NDX. And, this had some really strong moves, coming off these lows over the summer. But at the same time here, it's possible that the Russell just bleeds lower relative to the NASDAQ. And I think that's really more of where we are now. If you look at the NASDAQ, it really hasn't done as much. It's just kind of holding up here. And so what we could simply see is the NASDAQ is down basically for 4 straight days, and it's barely fallen. It's just kind of sitting and waiting, and the 8 days catching up. And maybe that's really all there is to it. And of course, what do we have next week? We have earnings from Nvidia. So, that kind of puts the focus back on the AI trade next week. So I think that, now we could be really in a spot more where we see a return to the large caps, and this alleged Trump trade, maybe that just kind of goes away for a while. The financials, the banks, the small caps, and we just go back to, the big trend that has been dominant for so long of large cap growth.
Nvidia reporting earnings next week is something that just immediately caught my attention because, as we know, that's been a key driver in the market. A large holding now in the S&P 500, a large holding in the Nasdaq 100. I believe it was once again the largest company in the world by market cap just recently. So if you're listening to this chat, take note of that. Next week, Nvidia earnings, something that you're probably going to want to have marked on your calendar. Another aspect too that I want to get back to is you had the ratio chart open as well, actually, before you even get to the ratio chart, the S&P 500 chart you have open, a viewer was asking you about the way you draw Fibonacci. And, in our chats, we've spoken a number of times about the techniques that you bring to this show. RSI cooking, which we spoke about just a little bit ago. If you're curious about learning more about David's methodology around RSI cooking and how the indicator works, we've done this live stream monthly for a number of months now. You should go watch those specific videos. But in terms of Fibonacci, I do agree with this viewer. I also like the way you draw Fibonacci. It's simple, it's crisp, it's clear. Maybe walk us through why you do draw your Fibonacci tools, with this 3-line approach.
Well, I have just found that when something makes a move and then it basically retraces half of it, it has been, to me, consistently something that has given a validation of that move. So I think that's the first thing. And the second thing is I chose to go from this level because that's the highest level. And in some ways, that's the most conservative place to draw it. If we drew it all the way down here, then it would basically give us a lot of leeway to be wrong. And I often have found that in this market, old resistance has not become new support. So just because we go down and if we break under this low, then it's potentially more likely that that's going to become more of a bearish sort of phenomenon. And so the fact is that the thing I like about this is that it was a clear, discernible event. The breakout above the high because of the election, all that sort of thing. There were people who probably FOMO'd in on Wednesday morning, and now we're holding half of that move. And I think that's really, from my perspective, the key thing is it what was the actual move? You could say it started down here. That could have been possible, or the election could have ended up in a difficult way when we were still counting the ballots now. And then this would have just become, basically a lower high before continuation to the downside. So I think it's important to realize that the real move was this surge above those highs. And if we draw it that way, then we have a relatively clear sort of thesis. The other thing I liked about it is it has confluence with the 8-day exponential moving average coming higher and with the support level that I independently identified. When I was looking, I said, where do we really see here where do we see a low that could be valid? Because I believe in this market, looking for support at lows has been far more effective than looking for support at old highs. That doesn't always work as well. But the thing is that in this case, that low, there are people who bought on Thursday morning. They would have bought at the open on that day, which was 59.47. That was the low of the day. And then basically that to me seemed like the most logical support to look for. So I had the support based on purely charting levels. I had the support based on Fibonacci, and I support based on the 8-day exponential. So these things came together, and it helped to validate selecting that level.
Love that you use Fibonacci specifically for that 50% retracement of the move. That is simple. It's concise. It's a nice way too for people to remember that, nothing just goes straight up. There's always sort of an oscillation, and there's there's oftentimes little drawdowns within the broader uptrend, or you could vice versa, uptrends within the downtrend if you were betting against something. But thanks for that explainer, David. I know that this particular viewer was curious about that. Concise and to the point. And what other charts do you have for us since sort of all of this has unfolded in markets with the all-time highs and the other big moves that we're seeing?
Well, I want to say I've done something that maybe, for people who have watched me might be a surprise. And that is I did today an idea looking for upside in an oil stock. And it's interesting to me that higher interest rates are consistent with the idea of a stronger economy. They're consistent with the idea of inflation. And energy stocks have tended to outperform in periods of rising interest rates. So today I did Marathon Oil. You can see the TradingView idea I did on it. There's a different chart, but it was basically there was a line across here and some other stuff. And the thing I thought was interesting was the way it was holding this tight sort of level. But if you look at XLE, which is the energy ETF, what's interesting to me is that for a long time I was, much more on the bearish side of things, looking to be a seller at around 94, 95. And, we have spent now more than a week breaking that level. And I think now we could be setting up for something. If we look at a longer term chart of XLE, the energy ETF, and we can see here now that on the long term, we're still below where we were in 2014. Now, I'm not sure that level even matters anymore. Um, but the thing about it is that we have this falling trend line that we broke on the weekly. We have this resistance level that we're trying to break through on the weekly as well. So from my view here, it looks to me like there's something coming together a little bit on the energy sector. I'll also look at the U.S. oil, which is just a nice index. And what's interesting yesterday is if you look on like a 15-minute chart, look at this quick dive down below 67 with a very fast rebound. So this is now something that might be giving a little bit of a sense that we have some support in place on energy. I think now we actually might want to be looking to see if this is actually an area that people actually kind of maybe start to see, do we get a breakout? Does this level hold? And do we get a breakout? And what's interesting to me is that the energy stocks are telling us that we might. The energy equities are pointing higher on the overall energy complex. So I think this is actually something now where there's been a lot of bearishness in energy, and I've been one of the people highlighting those negatives. However, at this point in time, the chart, again, going back to Mark Douglas, the opportunity flow now is not, in my mind, pointing to the downside, but on energy here, it's potentially pointing for a breakout after a long period of consolidation, really going nowhere since April. This has had a very tight range, and that could mean there's a lot of people in here who, basically, if they've bought it, they're up a little, but they haven't really enjoyed the breakout and enjoyed the rally. So, much higher, this thing might sneak and get some people chasing it. So I think this is actually something that might kind of come out of the woodwork that we didn't expect.
And that is also very interesting in the context of the election wrapping up and the cabinet members coming in, the new sort of personnel that will be in the administration, because I have been reading that might be a more bullish push toward oil. Even, there was some rumors today and some news articles floating around that I think it's $7,500 EV credit that is given to people who buy electric vehicles might come to an end as well in 2025, which naturally is then going to favor cars that run on gas. So that is interesting. I've not looked at the energy sector like this until you just brought this up, but now that you're speaking about it, it's kind of aligning with some of the headlines, which is fairly unique at this point in time.
And the inventories have not been. I mean, there's been some strange noise with the inventories and stuff, but it's just that we have now priced in the negativity in terms of things like China and all these things. I mean, those things are now known, and I think we have to be careful of once everything is known and the whole pendulum swings in one direction. If it's not able to follow through in that direction in terms of more downside, then it can go the other way. And the oil inventories are inching higher, but they are nowhere where they were back before the pandemic. So the idea of oil just collapsing might not be ready for that. We might not be ready for that to happen yet.
And how about some of the other sectors or industries that you're looking at? And by the way, I saw your Marathon Oil idea on TradingView as well, and I'm going to drop a link to that in the chat. So if anyone wants to read about David's latest research on Marathon Oil, the charts, the price action, ticker MRO, I'll drop that link in the chat or the comments, and you can go check that out. It's right on their TradeStation profile on TradingView. But now let's go back now to David's charts to see what else he's got prepared for us.
I'm going to make a really quick lesson, though. Look at MicroStrategy. Look at how it
this
rallied.
Is a good one.
Yeah. And this is not anything I see an opportunity now, but look at how this one broke out before Bitcoin broke out. Okay? So the thing is, look at oil stocks trying to break out before energy. So these things happen. You often will see the equities move before the underlying commodity, if you want to call, Bitcoin an underlying commodity for MicroStrategy. So that's just another thing to think about. At this point in time, who knows really? I don't even have a view of Bitcoin. I don't want to talk about it, but it's more a question of the fact that we often see the equities move before the associated hard asset, so to speak. So now, in terms of some other things that were jumping up for me, I want to just mention that I
Hey,
continue.
David, actually, just quickly, could we go to that MicroStrategy chart one more time? Just
Mhm.
the MicroStrategy chart is fascinating too, just from a standpoint of I just read the other day that they have a price to sales ratio of 160. And so, I mean, remember, that's not why people are buying it. It's involved in all sorts of other businesses. But my point just being is this chart is, yeah, just a remarkable move that has a lot of people just sort of chatting, you could say. And I would also say that it was a large holding at one point in the IWM Russell 2000 index. And I had
Mm.
to uncover that on my own because the Russell 2000 index had a huge boost the other day. And naturally, I thought, oh my gosh, small caps, here comes the big move. Sure enough, from what it looks like, a big percentage of that move was from this chart we're looking at.
Mm.
So fascinating chart. I don't know what to make of it either, but it's interesting. This is almost $100 billion company.
Yeah, I mean, crypto is not something I know enough about to say much about it, but I wanted to just point out that phenomenon. I've seen this repeatedly, where the stocks will move before the underlying asset. It's interesting here. MicroStrategy broke out on October 11th, and then if you look at Bitcoin, the same time, October 11th, basically it hadn't broken out. So in many ways, if you had taken your cue from MicroStrategy or some of the other crypto related stocks, it might have told you something. So that's one point there. Now,
Great point, by
um,
the way. It's almost like you're looking for the tell. If you know where to look, you can kind of spot what the market's thinking before it takes place in those hard assets. Super interesting point there. Note taken.
all right, good. Now, um, the next thing I would look at was the SOX, the Philadelphia Semiconductor Index weekly chart with this triangle forming. S&P hitting new highs recently, and this thing nowhere near new highs. So I think we have to realize here it's been interesting to watch the software names break out to new highs, communications break out to new highs, but not semiconductors. The XLK, which is the technology ETF, not hitting new highs. It's been basically something of a double top on the XLK. So this is technology sector, double top. The SOX with this kind of triangle. This is, to me, I think, something that also gives more of a reason to be more on the negative side. And so, that might be kind of more, now the S&P is kind of trying to break potentially through some support. So I think we have to kind of realize maybe the kind of, the problem is sometimes, things can go either way. And I want to just mention that because we had identified that kind of level, and here we are just barely trying to hold it. But I mean, the thing is, if you were to look, imagine, for example, this is the high on the tech stocks, on the chip stocks, and then we actually look back. This is actually a pretty potentially bearish sort of situation here. This lack of high and this kind of tight triangle, it's really squeezing here. And from my view here, this is something which could be setting up for more sort of downside. And I think we have to focus on this. I'm not sure if it's still true as of this moment, but by far semiconductors have been the leading group and sector this calendar year. And pretty much ever since this current bull run started, I put it at March in many ways of last year. I think that's when the bull run really started. Coming off the lows of October 2022 was kind of like, ending the bear. But this run really started, in my opinion, with the Nvidia conference in March of 2023 when AI took off as a theme. And, it has been showing real signs of fatigue here. So I would just say here that this is, to me, a really important thing to look at. If you look at the SMH on the daily chart as well, which is the ETF, you can see more clearly. You can see here that there was this kind of bearish sort of level, this gap down right here, and we have stayed below it. So from my perspective here, this remains more of a reason why I've been getting a little bit more cautious recently. This failure to break out, you could even say in some ways that this is something of a double top below that. I've often seen this pattern, and in my mind, this is actually a very bearish pattern when you basically have a double top below an old high. So from my view, this is something here where if we do start to get a break lower, realize where we are on the weekly and realize that if this breaks lower, people are not going to be buying it right here. They're going to be looking to here, right? Or lower. And I think that so just realize is that this has been squeezing, and we could see something of a sort of explosion in volatility if this breaks. So just realize that we're sitting on that. But again, something like this might sit for weeks before we really get the confirmation. So here we have an inside week, a break below last week's low around 49.61, 49.60 might kind of be the thing to look at.
Well, I'm going to have to say this is particularly interesting as well in the lens of something you said earlier in the show with Nvidia reporting earnings next week, because
Yeah.
all of the technicals, all of the price action, the chart you just walked us through it's fascinating to see all of it culminating on the chart with this big report coming up. And it looks like you just pulled up a chart of Nvidia. What are you
Yeah.
watching here or thinking here?
Well, I think we have to see, because I mean, if we don't hold this and we break down, I mean, this is going to potentially be a false breakout. I mean, this is, in the scheme of things, I mean, we could probably actually say, if you look at this and you look at this, I mean, this is now turning into something of an ascending wedge, which is basically, you could draw it a few different ways, but I mean, that is not a bullish pattern. That's basically a pattern when your highs are getting only slightly higher, and you're not getting the follow through from the lower highs. You're squeezing into a narrowing range. This is a potentially bearish reversal pattern. I might actually do a TradingView idea on this one. I'm kind of trying to watch this and see, but I would say that if we don't hold this high, that we had back here in late October, that could be something kind of problematic. But at the same time, you got to remember that the earnings could be the thing that actually triggers it. So we have to just, I think, realize that the actual timing of it could very well be linked to the actual event, and to not be getting ahead of ourselves. But a lot of these things are to me, there are a lot of things here that are making me think that there is the potential for the market here to be more or less topping out. And I would just say the thing about the interest rates, but then the other thing is just the fact that in some ways the catalyst now, everything is kind of known. We have relatively high multiples, and we have, at this point in time, expectations of earnings getting better. All of these things are just kind of known, and then you have to wonder, what is the next thing that's going to come along in the next 1 to 2 months before year end that can give any kind of clear catalyst to push prices higher? I'm not sure I really see those. Now we have no earnings for a while. We don't have a lot of important economic events. The Fed is more or less done with what they're doing. They're probably going to cut in December, but beyond that, who knows? So we're kind of in a spot now where the market is relatively expensive. It's also been running for almost exactly a calendar year, which means people who bought in late October, early November of last year are now sitting on long-term capital gains that they can sell at a lower rate. So the fact is, all these things kind of give some potential here to say this might actually be, something of there's arguments increasingly for people to be a little bit more, I think, cautious. And again, though, from a trading perspective, those kind of speculations are something we have to be careful of, because they can lead us astray, and we have to wait for the clear confirmation. And I continue to watch things like the level in the S&P that we're actually now breaking. As I look at the S&P right now, is actually breaking that level, that low from the post-election Thursday. It's breaking that Fibonacci retracement. So maybe we're actually going to be more going in that direction here. We have the 8-day exponential coming up, but I still think this is something where it could be more giving us that negative sign. I did want to hit briefly on gold, because gold is massively oversold. And we have a level here from mid-September. And if you look on the, I had this actually on the daily chart. I had my stochastics on gold I wanted to keep up, because this hit a very oversold level. This is one of the lowest levels on stochastic for a very long time on gold. So I wanted to just kind of mention that. And I think this is something where people might want to actually just kind of be aware of the fact that gold has really taken a beating here. and it's been in something of a bull market. So I thought it was interesting just to notice the fact how oversold it is, and the fact that it seems to be holding a weekly level.
Well, I have to say on the gold chart that this, especially in the lens of the Nvidia chart as well, actually there seems to be some notable movements happening in these these high market cap areas of the market. Gold's market cap is something like 11 plus trillion. Nvidia's market cap is 3 trillion. It's got that wedge forming. It's got earnings coming up. So all of this actually is catching my attention. As you just said, I was trying to see what the S&P 500 was doing when you said it looked like it was breaking those lows. It is interesting to see all of this unfolding and right here on the live stream. And I hope all of our viewers are also taking a note of how someone like David is thinking through the process. And also he's kind of giving us a live tutorial on how you can watch these things yourself. So I do know too, the market closes in about 9 minutes here, David. I know you like to get to the you like to get to your trading desk before that closing bell goes off. With the last 4 or 5 minutes here, is anything else that we should inform our viewers about, or specific things to watch in markets?
Well, I was actually looking at, it's just a very simple sort of tactical thing, but I was looking at how Google or Alphabet kind of on the daily chart had this rally on earnings, the pullback, then the rally on the Trump election, but really not doing much of anything here. So I was just wondering if maybe this comes back down and tests closer to kind of 170. This might be actually a name that when we look at what's happening now, with the potential of maybe changes with the, regulatory antitrust environment, that this might be actually an area where some of the negatives are maybe kind of fading. The last results were very interesting, and it hasn't done a whole lot. So this might actually be, I think, as we speak, this one might actually be a bullish inside. No, it's not quite. We had inside week last week, which is had a move, a bullish inside move, and now it's just kind of holding. I want to just kind of mention here that I thought Alphabet is one that is it might be something here where it kind of chops around for another short time, but people might be actually starting to see some potential here on this kind of move. Maybe something down toward around 172, but that was one that really jumped out to me. The other one that I had to mention was Philip Morris, not a very active name, but it had this gap on earnings and now it's holding. I noticed it this morning, and then it had a nice jump higher today. But I think this is another one that, looking at from a momentum perspective, that it seems to be, it's kind of holding this level. So I wanted to point out those. Those are just the ones that popped up for me. And so I'm going to be watching essentially the S&P here to see how we, kind of do at that support level. Keep my eye on the 10-year. And tomorrow morning we have retail sales as well. That could be another catalyst to give us some direction.
I was just going to say, as we wrap up, any upcoming events also on your mind? So retail sales is interesting, just with, speaking of catalysts, Black Friday, the Christmas season, the holiday season, which is great for consuming spending and some economic activity. Any other economic reports or earnings reports on your mind? And then we'll wrap up the show and make sure everyone viewing and yourself can get to the closing bell.
Fed minutes for next week on the 26th. Given what Powell might have been kind of saying today, he was slightly a little bit hawkish. I think we could be in a spot where next week those Fed minutes, they might say something in there that make people a little bit nervous. So that would be maybe a potential catalyst as well. Sometimes Fed minutes, you forget about them and they come out and hit you in the face.
That they do have a tendency to do that. And then everyone remembers how important they are. They all tune in for the upcoming one. Nothing happens. The next one, they forget about it. Then they sneak up on you. It's an interesting cycle. And I'll just say, actually, very interesting as we wrap up the show too, is I was just looking at some stats about the time of the end of the election to the inauguration. And actually the current market move barely ranks in the top 3. I guess Biden's 2020 election was the largest gain from election night to inauguration. Yeah. So that was just a little stat I was looking up as we were chatting, because I know it's come up a few times and it's played a role in a lot of this market action. So on that note, ladies and gentlemen, Dave and I are going to wrap this one up so we can all get to the closing bell. And please remember to follow TradeStation on TradingView. You can access David's research. He even walked us through that Nvidia chart just a bit ago, and he might be creating an idea about Nvidia and that chart with earnings next week. I know I'm going to have that on my calendar with my alerts set, because that's a big report. first or second largest market capitalized company. So be sure to follow TradeStation on TradingView. And David, thanks again for joining us for another excellent show. We got 5 minutes here to the closing bell, and we will see you next month.
Have a great Thanksgiving, Steph. Take care.
Thank you, David. Cheers.